Alphabet's second quarter of fiscal 2026 was not just strong. It was the kind of quarter that forces investors to rethink what this company is becoming. Revenue reached $119.8 billion, up 24% year over year, marking the 12th straight quarter of double-digit growth. Search remained the foundation at $63.3 billion, while YouTube added $11.1 billion. Combined advertising revenue reached $81.6 billion. But the growth story is broadening. Subscriptions, platforms, and devices contributed $12.9 billion, while Google Cloud surged to $24.8 billion, up 82%. Gross profit reached $73.9 billion, and despite heavy investment in AI, operating income climbed to $40.8 billion, lifting operating margin to 34%. Then came a number that changed the entire income statement: approximately $98 billion in investment gains, pushing net income to $112.2 billion and diluted EPS to $9.11. The headline profit was extraordinary. But underneath that one-time surge, Alphabet's core businesses were also accelerating and generating the cash needed to build something much larger. Step back from a single quarter, and 4 years of segment data reveal a deeper transformation. Alphabet's quarterly revenue increased from $69.7 billion in Q2 fiscal 2022 to $119.8 billion today. Search remained the largest engine, rising from $40.7 billion to $63.3 billion, while YouTube advertising advanced from $7.3 billion to $11.1 billion. But Google Cloud was the clear standout. Revenue expanded from just $6.3 billion to $24.8 billion, representing annualized growth of almost 41%. Subscriptions, platforms, and devices also compounded strongly, while Google Network moved in the opposite direction, declining at roughly 3% annually. So Alphabet is still growing because search remains resilient. But the composition is changing, with cloud and recurring subscriptions becoming increasingly important to the company's next phase. Now break the quarter into the 5 engines that really define Alphabet's future. First, Google Cloud. Revenue reached $24.77 billion, up 82% year over year, while operating income more than tripled to $8.81 billion. But the deeper signal is the backlog: $514 billion in contracted business, with more than half expected to convert into revenue within 24 months. That suggests enterprise AI demand is not simply strong. Much of it is already locked in. Second, Google Search and Other. Revenue reached $63.27 billion, up 17%. Instead of being displaced by conversational AI, Google is integrating AI directly into its core product. AI Mode, smarter shopping results, and more complex queries are creating additional touchpoints and new monetization opportunities. Third, YouTube and subscriptions. YouTube advertising generated $11.06 billion, up 13%, while subscriptions, platforms, and devices rose 15% to $12.91 billion. YouTube is no longer just an advertising platform. It is becoming a wider ecosystem built around video, creators, premium subscriptions, and commerce. Fourth, Gemini and AI infrastructure. Capital expenditure reached $44.92 billion this quarter, while full-year guidance increased to between $195 billion and $205 billion. Gemini API usage is running at roughly 22 billion tokens per minute, and the Gemini app has reached 950 million monthly users. Demand is no longer the main constraint. Available computing capacity is. Finally, Waymo and other bets. Waymo now delivers more than 500,000 weekly rides and logs over 4 million autonomous miles each week. It remains small compared with search or cloud, but represents one of Alphabet's most valuable long-term options in physical AI. Search funds the machine. Cloud scales the future. AI infrastructure absorbs the capital. And Waymo opens the door to an entirely new industry. To understand Alphabet's durability, zoom out to the global digital advertising battlefield. In 2026, Meta is projected to generate roughly $243.5 billion in digital ad revenue, with Alphabet almost level at $239.5 billion. The gap to Amazon and ByteDance is enormous, confirming that this remains largely a two-company contest. But the more important number is the growth rate of the market itself. Global digital advertising is projected to expand at a 12.1% compound annual growth rate, reaching nearly $1.38 trillion by 2030. Alphabet's advertising revenue is expected to grow more slowly, at a 9.8% CAGR, rising from $149 billion in 2021 to nearly $347 billion by 2030. Because Alphabet is growing slower than the overall market, its share could decline from 30.2% to 25.2%. Normally, losing market share would be a warning. Here, it means Alphabet could own a smaller percentage of a dramatically larger market, while still adding almost $200 billion in annual advertising revenue. Back inside Alphabet's core engine, AI is reshaping both the revenue opportunity and the cost structure. Search and other generated $63.27 billion, up 17%. AI-powered experiences are creating more complex queries, longer engagement, and richer commercial intent. Google is no longer simply returning links. It is increasingly guiding users through discovery, comparison, and purchasing decisions. YouTube advertising contributed $11.06 billion, up 13%, supported by enormous audience scale and premium pricing power. At the same time, Google Network slipped approximately 1% to $7.30 billion. That suggests advertisers are gradually moving spending toward Google's own properties, where the company controls the audience, recommendation system, and performance data. The ecosystem also extends beyond advertising. Subscriptions, platforms, and devices reached $12.91 billion, up 15%, as more free users convert into paying customers. Supporting this entire operation were $16.2 billion in traffic acquisition costs and a workforce of 198,933 employees. Even after carrying those costs, Google services generated $94.54 billion in revenue and $39.5 billion in operating income. The central question is whether stronger engagement and monetization can continue growing faster than the rising compute cost of every AI-powered query. Alphabet's advertising power ultimately depends on one scarce resource: attention. And nowhere is that clearer than in American living rooms. Streaming accounted for 38.3% of total U.S. television time in April 2024. By April 2026, it had climbed to 47.6%, meaning nearly half of all television viewing now happens through streaming platforms. YouTube was the largest individual contributor, increasing from 9.6% to 13.4% of total TV time. Netflix remained relatively stable at 7.8%, while Disney Plus reached 5% and Prime Video 4.2%. This transforms YouTube from an online video platform into a central gatekeeper of household attention. The more television viewing it captures, the more valuable its advertising inventory becomes. YouTube is therefore not just another growth business inside Alphabet. It is one of the company's strongest defenses against the fragmentation of consumer attention. Now turn to the business that may matter most for Alphabet's long-term re-rating, Google Cloud. The global cloud infrastructure market reached $129 billion in Q1 2026, up 35% year over year. AWS remained the leader with 28% share, followed by Azure at 21%, while Google Cloud held 14%. Oracle and Alibaba each controlled approximately 4%. But the direction of travel is more important than the current ranking. Since early 2022, AWS has declined from 33% to 28%. Azure has expanded from 16% to 21%, while Google Cloud has increased from 10% to 14%. Google still trails the two leaders, but it is steadily gaining ground inside a market being accelerated by enterprise AI. And because cloud infrastructure now sits directly beneath the AI economy, every additional point of market share carries far greater strategic value than it did a decade ago. Look deeper into the cloud race, and four distinct strategies emerge. AWS, with 28% market share, remains the scale and reliability leader. Its 39-region footprint supports a vast global ecosystem, while the Susquehanna Power Agreement could provide up to 1,920 megawatts for future AI capacity. Trainium 3 strengthens AWS custom silicon strategy, targeting up to 4.4 times the performance of the previous generation. Its €7.8 billion European sovereign cloud investment also addresses customers that require local control over data and infrastructure. Microsoft Azure, with 21% share, competes through enterprise integration. More than 70 regions and over 400 data centers connect Azure with Microsoft's productivity, identity, and business software ecosystem. Its OpenAI partnership reinforces its position in enterprise AI, while an 835 megawatt power agreement and the Blue Sovereign Cloud in France support future capacity and regulated workloads. Google Cloud, with 14% share, is focused on AI efficiency. Gemini Enterprise is processing approximately 22 billion API tokens per minute. Ironwood systems can connect 9,216 TPUs in one pod, delivering 42.5 exaflops of compute. Google also operates with a fleet-wide power usage effectiveness of around 1.09, while its partnership with Thales supports sovereign cloud requirements in France. Oracle, with only 4% share, is targeting extreme computational density. OCI superclusters are designed to scale toward 131,072 Nvidia B200 GPUs, supported by both Nvidia and AMD accelerators across 48 public regions. AWS leads through scale. Microsoft through enterprise integration. Google through AI efficiency. Oracle through dense compute and regulated infrastructure. This is no longer merely a cloud market. It is a contest for energy, silicon, sovereignty, and control of the enterprise AI stack. Alphabet's 2030 strategy begins with the cache engine it already owns. Google services generated approximately $94.5 billion this quarter, including $63.3 billion from search and $11.1 billion from YouTube advertising. Search captures commercial intent. YouTube captures consumer attention. Together, they are financing an AI infrastructure program approaching $200 billion in annual capital expenditure. That money is being converted into data centers, networking systems, and custom processors. Alphabet is using the profits of the internet era to build physical computing capacity for the AI era. But the strategy carries real risk. Search distribution agreements and Google's position in advertising technology remain under legal pressure. Any major restriction could weaken the cache engine funding this transformation. Waymo provides a different kind of opportunity. Its autonomous driving network is expanding across more than 10 markets, creating a proprietary physical AI data moat that few competitors can replicate. The commercial flywheel then moves into Google Cloud. Contracted backlog has reached $514 billion, with more than half expected to convert into revenue within 24 months. Gemini Enterprise is designed to transform Google Cloud from an infrastructure provider into a platform where AI agents can access data, reason, and execute complete workflows. Underneath Gemini is Alphabet's proprietary hardware stack, combining Axion CPUs with Ironwood TPUs. By controlling the models, software, processors, and data centers, Google believes it can reduce inference costs by as much as 67% compared with conventional GPU systems. That advantage could become decisive if AI inference reaches a $255 billion market by 2030 and consumes 75% of total AI compute. Alphabet's success will depend on 4 outcomes: expanding cloud margins, increasing TPU adoption, scaling Waymo, and proving that its enormous infrastructure investment can generate equally powerful returns. Of course, building that future is getting expensive. Alphabet's operating expenses reached $33.1 billion in Q2 fiscal 2026, up from approximately $18.3 billion in early 2022. Research and development is carrying most of the increase, reaching $18.2 billion after rising nearly 32% year over year. But the important point is not simply that spending is increasing. It is where the money is going. Alphabet is investing in AI models, engineering talent, and the software required to turn its physical infrastructure into profitable services. In the short term, those costs pressure free cash flow. Over the long term, they reveal management's priorities, and those priorities point directly toward AI leadership. Now compare revenue growth with net income, and the quarter looks almost surreal. For most of the last 4 years, Alphabet's net margin remained between approximately 18% and 38%, even as revenue steadily increased. Then it jumped to 57% in Q1 fiscal 2026 and exploded to 94% this quarter. Net income reached $112.2 billion on revenue of $119.8 billion. but the surge was driven primarily by approximately $98 billion in investment gains. So the reported margin is clearly not a sustainable operating baseline. Still, the chart reveals an important second truth. Even beneath the accounting distortion, Alphabet's operating income continued growing faster than revenue. The headline profit was unusual. The underlying operating leverage was real. A cleaner measure of Alphabet's momentum is its performance against revenue expectations. The company has beaten Wall Street's revenue estimate in 8 of the last 9 quarters, with only a narrow 0.2% miss in Q4 fiscal 2024. This quarter, Alphabet delivered $119.8 billion against an estimate of $116.5 billion, a 2.9% beat and the strongest surprise shown in this period. Looking ahead, consensus projects $126.2 billion next quarter, followed by $139.6 billion in Q4 and approximately $145.4 billion by Q2 fiscal 2027. Analysts are therefore not treating this as a one-quarter spike. They expect sustained growth supported by search resilience, YouTube scale, and accelerating cloud demand. Earnings per share tell an even more dramatic story, but they also require more caution. Alphabet has exceeded EPS expectations in each of the last 9 quarters. Then this quarter moved into a category of its own, $9.11 in diluted EPS against the $2.88 estimate, representing a beat of more than 216%. That surprise was driven largely by the investment gain, not by recurring operations. Investors, therefore, should not annualize the $9.11 figure as Alphabet's normal earnings power. The more useful signal is what comes next. Consensus still expects EPS to rise from approximately $3.02 next quarter to $3.60 by Q2 fiscal 2027. The investment gain created the spectacular headline, but the underlying earnings trend is also expected to keep moving higher. So after a quarter this unusual, what does Wall Street believe Alphabet is worth? The average 12-month price target shown here is $428.45, implying approximately 28% upside from the reference price, near $333.71. The range is wide, from $340 to $550, reflecting a real debate over how much value Alphabet can ultimately create from its AI investment cycle. The ratings themselves are far less divided. Among 73 analysts, 59 assign a strong buy, 6 a buy, and 8 a hold, with no sell ratings shown. But that optimism does not eliminate the central risk. Investors remain concerned about capital expenditure guidance of $195 billion to $205 billion, and the pressure that level of spending could place on free cash flow. That is now the defining Alphabet debate. The company is no longer being judged only as a high-margin advertising platform. It is asking investors to fund a more capital-intensive transformation into an AI infrastructure leader. The upside could be enormous, but Alphabet must still prove that today's spending will become tomorrow's durable competitive moat. The views expressed in this video are for informational purposes only and do not constitute investment advice. Thank you for watching. Please like, subscribe, and share this analysis with anyone following Alphabet, Google Cloud, and the global AI infrastructure race.